Hey everyone, welcome back to another episode of AWM Insights. We concluded our series on building best-in-class human-centered investment portfolios. We're going to go back to our normal programming here and just talk about the markets today. Talk about how we're viewing what's going on, interpreting what's going on, how we think about it as it applies to a lot of our core pillars of investing today. And as you guys all know, we love following the happenings within the market, and there's usually never a shortage. We're entering the summer months. Can be a slow time, but in the last few years, it really hasn't been. There's this great old adage of sell in May and go away. And guess what? We just had the best May in 30 years, up 6%, the S&P 500, that is. So market has rebounded quite a bit off of the lows, the tariff-induced lows, let's call it. And yeah, there's some interesting stuff going on that we're certainly keeping an eye on and want to talk about today. So, Mina, why don't you jump in? Give me your take. What are you looking at? What's going on? What's keeping your attention right now?
Yeah, I think the rally in May has been super interesting and was super interesting to see because there wasn't a whole lot of just positive news that came out, but markets still rallied. And if you really think about it in terms of scale, markets are up on average less than 1% a month, 6%, that figure, that's 3/4 of return realized in 1 month. So yeah, kind of crazy. A little bit out of the blue too. Like I said, there wasn't a ton of data that came out to propel markets forward, but it's really comes down to one of our core tenets of not being able to time markets. You can't time markets. You don't know when you're going to realize this massive up month, and if you're also operating based off news, based off predictions, everything that you're reading about, researching, this totally blindsided you.
Yeah, right. Discipline, long-term focus, all these things we say time and time again, and we say them time and time again for good reason, are just reinforced, right? You're going to see headlines of like, oh, so-and-so got the timing right. But those are outlier events. Those are outlier predictions. And they're not the way you build a consistent, repeatable, higher confidence investment solution or investment portfolio. I mean, we went through kind of the nitty gritty of actually how to do that over the last 4 or 5 episodes, but you see episodes like this and they're just great actual data points, data reminders of why we say what we do, right? I think we've said this before, but we don't have these pillars and have this philosophy just because it sounds good, or because we feel like it. It's very much rested in just hard data over many market cycles. And yeah, go for it.
Yeah, the data tells you that in terms of market timing, people buy high and they sell low. They get scared and spooked in times like COVID, in times like Liberation Day. That's when funds and flows actually leave equity markets, leave stocks, leave risky assets, and they go into more conservative asset classes, which don't actually benefit from the rebound. So yeah, it's exactly what you just said. The data is pretty overwhelmingly against timing markets, and unfortunately, human emotions outweigh data.
Yeah, 100%. And I've been thinking about that general topic a little bit lately, where periods like this short period of time, let's call it since the lows, and there's many other periods over the last, 5-6 years where you can get trapped into complacency. You're like, oh wow, actually, I just buy the dip and keep riding this, or this game is quote unquote easy. And I'm old enough now, I unfortunately have to say that, but old enough now where I've seen huge market corrections, whether it be the great financial crisis in 2008, 2009, where there were substantial drawdowns. Even going to more recently, some folks who are listening know the COVID period of time, right, where there are these fierce drawdowns that happen quite viciously. And that's that's really what we're prepared for, not kind of these little more short-term points of volatility. And that's when your discipline is truly, truly tested, I would say. And we're reminded, right, where you miss the best days, the recoveries, which happen super fast, it decimates your returns. And so, luckily we're not in any crazy periods of time. There's a lot of uncertainty right now, and there's been heightened volatility, I would say, year to date. But we haven't experienced these crazy bouts of strong, severe drawdowns, and hopefully we won't for a while. We will at some point, right? It's kind of like it is one of those inevitables, I would say. And we are constantly prepared and very vigilant there, where protecting on the downside and being disciplined is almost just as important as capturing it, arguably more important than capturing some of the upside that we're seeing. And yeah, I think it's great to remind ourselves this. We've certainly seen a positive month, and it's great to remind ourselves that when we see positivity in the market, just as it is when we see negativity in the market. Maybe shifting to more of the macro side of things, macro being a term used for just the economy, what's going on broadly speaking in the economy. I kind of alluded to a little bit of uncertainty. There's obviously volatility that's we've seen in the market, both up and down volatility, largely driven by what's going on the macro side of the equation. We don't need to hash out all the specific news items, but just what are we seeing there? Is it clear? Are we out of the woods? Is it a mixed bag? How are we interpreting that?
Yeah, it's super unclear, and we are getting mixed signals, and getting hot signals some days, cold signals other days. I think that's why the rally has been so interesting. And if you really look at it, it was kind of just up and to the right. You didn't really get many big negative days in May. And this is just off of, mixed economic data, mixed manufacturing data, nothing really that's pointing to just rosy streets ahead. But nothing that, tells us that we're in the path of a recession. I would say maybe the only really big piece of negative data has been the U.S. debt downgrade. We've seen that a few times in the past. I don't think it's a massive surprise, something that we've discussed internally. But the market's reaction to that even was pretty muted. I think the market was up the day that it actually happened. So you never really know how news gets processed by markets and by those, trading on a daily basis.
Right. And that, can kind of speak to market efficiency, right? The market probably already assumed that that's where the debt rating was for the U.S. So great reminder of market efficiency there. I would just add to that too. Yeah, it's very unclear. There's kind of a mixed picture, right? We saw some data slightly to the upside from the Bureau or Department of Labor on job openings. But then today, as we're recording this is June 4th, this week, the ISM Services Index, it has weakened and been weakening quite a bit. So we are seeing potentially some impacts of the tariffs now that they got theoretically delayed. We'll see where the courts take all that and how that dust settles. Right now, there does seem to be some bleeding into the overall economic picture, and we're keeping an eye on that as well. One other topic I wanted to hit on, I think it's probably been seen by many of you all, but the gold market, both crypto and gold, let's call it. I kind of put those two things in the same category. Certainly from a trading perspective, they can be lumped together, but I think there's plenty of nuance. Maybe we can highlight at least our quick take on crypto specifically, but what's going on there?
Yeah, let's go through gold first, because that's an interesting one. So I think a lot of times people think about gold as mainly being a store of value asset, and it's trading, I think, now above $3,000 an ounce, and it is a store of value asset because if you remove that purpose and just looked at the industrial value of gold, a lot of people have studied this and been like, okay, if people don't believe of gold and don't look at it as an investment, how much would it be for? And the answers really are, it would probably be worth 90 to 95% less than it is today. So there's a ton of just speculation in terms of the value of gold. And recently that's paid off. Gold has done super, super well. But it hasn't done well because more people want to wear gold and people are buying massive, Cuban chains. It's because there's speculation going on and it's international speculation. Some people don't believe in their international currencies. We definitely see that in emerging markets. The US debt downgrade tying to that would be something that makes you, have a little bit more trust in a commodity like gold and move away from currency. So that's all great, but the people that are making these bets need to understand that there's a ton of risk with putting that amount of value into a commodity that doesn't really make you money. And it's all just, ballooned up with speculation.
Yeah, totally.
Yeah.
Well, yeah, just to add to that, we've spoken about this in previous podcasts, but it's worth highlighting again, just given the run that we've seen. Number one, in our portfolios, we have exposure to gold miners, et cetera. And those are companies that are actually creating value out of a commodity, right? To your point. So that's a framework we think about. Where can we create value? Where can we actually attribute value creation? So one reason why we don't actually allocate directly to gold is that. How do you value it? It is purely speculative. And hey, that goes both ways. It sometimes works, sometimes doesn't. But we've made the call that we just can't value that. We don't want to play that speculative game. Crypto, in a way, is a lot more nuanced. A lot of people believe Bitcoin specifically is now a digital gold. And in that case, the speculative nature and the speculative comment I just made applies there as well. But also talked about in previous podcasts many years ago that our take on crypto or blockchain specifically is actually it's a really interesting technology. We have a lot of exposure, a decent amount of exposure there in the private markets in this kind of picks and shovels type approach where, again, we want to invest in startups that are creating value out of this technology and a usable application of it. And that's kind of how we see the more, let's call it data-driven, evidence-based approach as opposed to just purely playing the speculative kind of gambler analogy within that space. So just wanted to hit on that briefly today. If it's something you all want to hear us talk a little bit more about, given what's going on in the market, happy to do that. Please reach out, hit us up for specific topics to dive into. But hopefully this just general take, kind of pulse of the market, our quick take was helpful for you all today. The two takeaways I want to leave everyone with is, look, at the end of the day, diversification is this like wonderful free lunch, right? It still can arguably be boring to go back to that, but it works, right? And when something ain't broke, don't fix it. Globally diversified portfolios help smooth out these bumps, capture opportunities when the market's giving you opportunities somewhere and you don't have to play this timing game. It works. And then this idea of evidence-based, data-driven investing where we can attribute value creation to something, or we can see where the data has been robust and really, really strong over history. And so that's those are core pillars that I would take and extract from this conversation today, and make sure we leave you all with. So with that, we'll wrap, and I'll say own your wealth, make an impact, and always be a pro. Thanks for listening.